Hey everyone, welcome to this explainer. Look, if you're into finance, you know there is a major shared frustration out there right now. We really need to talk about the middle-class squeeze. So many people are feeling it, despite playing perfectly by the traditional American dream playbook. You know the one, right? Work a single job, max out a retirement account, buy a house immediately. But for a lot of folks, that playbook just isn't delivering the stability it promised. So today, we're exploring exactly why that is.
It's honestly so validating to hear this out loud. Following legacy advice today practically guarantees you stay stuck in that middle-class squeeze. Seriously, if you feel like you're falling behind even while doing everything right, it's not you, it's the math. Elevated interest rates, changing tax structures, and stealth inflation have fundamentally, mathematically broken the old financial rules.
Okay, let's dive right into this. We are going to systematically dismantle 5 sacred cows of traditional finance today: the cash hoard fallacy, the starter home delusion, the 401k lockup trap, the frugality illusion, and finally, the corporate loyalty trap.
Starting with number 1, the cash hoard fallacy, or inflation versus devaluation.
So the outdated legacy rule tells us we need to keep our money parked in traditional bank savings. Keep it safe, right? But the modern U.S. reality is completely different. Big traditional banks are offering standard interest rates near, 0.01% to 0.05%? Meanwhile, real core living expenses, things like your housing, healthcare, education, they are compounding far, far faster than that standard yield.
The shocking math behind those percentages is literally eye-opening. If you're holding $20,000 in a traditional U.S. savings account at 0.01%, it yields a pathetic $2 to $10 a year in interest. Think about that for a second. By keeping your cash quote-unquote safe, you are actually bleeding purchasing power and losing thousands in real-world value to inflation.
So the crucial move here is making what we call the U.S. pivot. Instead of hoarding cash in a debt account, you maintain a strict 3 to 6 month liquid buffer in a high-yield savings account or a treasury money market fund to get those competitive rates. From there, you aggressively and automatically funnel all your surplus cash directly into income-producing assets. We're talking S&P 500 index funds like VOO or IVV, along with dividend and growth equity.
Moving on to Section 2, the starter home delusion and the myth of burning money on rent.
You've definitely heard this legacy rule. Buying is always better, and renting is just burning your money. But when we look at today's housing landscape, the combination of high 30-year fixed mortgage rates and massively inflated home prices completely flips the script. In major metro markets, homeownership has actually become significantly more expensive than renting.
Because, honestly, renting isn't the only way to burn cash. Consider the unrecoverable cost of homeownership, the expenses you literally never get back. You've got property taxes, which are annual government assessments. You have home insurance premiums, which are surging across the U.S. right now. Then there are HOA fees, and of course, mortgage interest, which is just pure bank profit on your loan. When you actually run the numbers, these unrecoverable costs often exceed the cost of renting a similar property.
Because of this, a totally new strategic solution has emerged called rent vesting. This means choosing to rent so you can set a hard cap on your monthly housing costs while keeping the mobility to chase higher-paying job markets. But here's the secret sauce. You take the price difference gap between renting and buying and you invest it into liquid market assets. That yields a much higher long-term velocity than tying up 100% of your net worth in primary home equity.
All right, Section 3, the 401k lockup trap and maintaining bridge liquidity. The outdated advice tells everyone to blindly max out their traditional 401k before doing absolutely anything else with their money. But the reality is, lockup accounts tie up your liquidity until you hit age 59 and a half. Now, capturing a company match is a 100% immediate ROI, and you should always do that. But maxing out beyond that match? That traps capital you might desperately need for midlife opportunities, like funding a business, acquiring real estate, or pivoting careers early. Let's move to and see how this builds with a much smarter sequence called the American hierarchy of funds. Step 1. Capture 100% of the employer match because that is quite literally free money. Step 2. Max out a Roth IRA or a health savings account for tax-free growth and withdrawals. And Step 3. Direct any excess capital to a flexible, taxable brokerage account. This is exactly how you maintain that crucial bridge liquidity before you reach traditional retirement age.
Section 4. The frugality illusion, the fallacy of the $7 latte. We have all been handed the legacy rule to cut out the daily coffee and just coupon our way to financial freedom. But let's be real, unless that $7 latte comes with a side of a mortgage payment, skipping it isn't going to cover your rent, your auto loan, or surging medical bills. Micro-optimizations simply cannot beat massive macroeconomic costs. Giving up small daily pleasures ultimately just creates a scarcity mindset, without actually fundamentally altering your real net worth. So the crucial point here is making an income expansion shift. Contrast the trivial scale of daily savings against the massive leverage you gain by focusing on your earning potential. Instead of hyper-focusing on saving $5, a modern worker should negotiate raises, launch freelance services, or simply switch companies every 2 to 3 years. That strategic move alone can result in a 15 to 20% salary jump, completely overshadowing frugal penny pinching. And finally, Section 5, the corporate loyalty trap, the death of the 20-year career. The obsolete idea was that if you stayed at one reliable corporation for decades, you'd be rewarded with complete job stability. Well, we know today that corporate loyalty is largely dead. Relying on a single W-2 income stream leaves you highly taxed. W-2 employees actually pay the highest effective tax rates in the U.S. Code. Even worse, it leaves you completely vulnerable to immediate zero-income risk from corporate restructurings or AI downsizings. The ultimate solution to this vulnerability is the U.S. income stack. This is the modern worker's checklist to create true wealth and stability. You maintain a core W-2 income for your base stability and loan qualifications, but you don't stop there. You add a side LLC or 1099 income stream, which unlocks powerful tax deductions, business write-offs, and solo 401k options. Then you cap the whole thing off with passive yield assets, leveraging index compounding and dividend reinvestment.
So, here is the big question. Knowing that traditional financial rules are mathematically broken in today's economy, will you keep playing by an obsolete rulebook that keeps you stuck in the middle-class squeeze, or are you ready to adapt, break those legacy rules, and start building your own U.S. income stack today? The choice is entirely up to you. Thanks so much for joining me on this explainer, and I really hope this empowers you to take absolute control of your financial future.